Following a price increase of 130% under 4 years, many people believe that the real estate market is in a massive bubble that is right at the cusp of implosion, with have serious negative effects later this year. The events of 2020 further cemented this. Simply put, American prices skyrocketed. In the Seattle market, for example, values rose by 30% in just a year, which was previously thought to be impossible, in what was arguably the hottest real estate market in history. Its unchecked rise not only alarmed the public, but also brought in millions of dollars for thousands of speculators. This epic 12-year run in values created a new bubble, one fueled by greed, speculation, and envy. Many are calling the amateur investment bubble, and it may just be the source of the next big crash that has already begun. This is not something that is commonly talked about or even accepted as a possibility until now. To truly understand this new bubble, we have to take a step back to the last one in 2008. The common belief was that the source of the big crash was this, the subprime mortgage market. But there is another side to 2008 that was never exposed. The truth is that there is significant evidence that this wasn't poor people who weren't repaying their loans. Analysis done by various researchers show that the 2008 crash was mostly caused by mom-and-pop investors. And if we dig into the details of this last crash, we can see a lot of similarities. Between then and now, you see there have been plenty of papers written since 2008, and these papers have been swept under the rug. Important research that claims a different catalyst started the fire to light the fuse on the entire financial system. Analysis shows that credit growth between 2001 and 2007 was concentrated in the prime segment and debt. The high-risk borrowers were virtually constant for all debt categories. During this period, the rise in mortgage defaults during the Troubles was concentrated in the middle of the credit score distribution, and mostly attributed to real estate investors. It's estimated at the peak of the market, almost half of purchase mortgage organizations were associated with investors. Many experts claim that it was house flippers that triggered the US housing market crash, not poor subprime borrowers. So what does this have to do with what is happening right now? Well, the same mechanisms that brought us to the peak in 2008, which seems to be happening in 2023. There is a hidden amateur investment craze that has clearly gone too far. Everyone today wants to be a landlord or flipper, and for good reason. The common belief is that real estate can make you rich, and if you push the envelope, it can make you rich really fast. Borrow from the bank using the FHA loan application. Buy a building. Renovate and sell for a much higher price that will boost your credit in getting a bigger loan. You can rinse and repeat this process until you've built up an insane amount of leverage and profit, allowing you to expand to larger projects, even getting into the commercial space. It works very well. You can get very rich doing this, as long as this continues to happen. Since 2012, homes have done nothing but go up, making many of these amateur investors very rich. However, if for any reason there is a downturn in the future, the same mechanisms that allow others to become millionaires in a decade will make them bankrupt in a month. This popular method has worked so well, inspiring millions of others to look at real estate investing as a ticket to millions. But there is too much borrowed money and a lot of fraud. There's thousands of investors who are operating at best in a legal gray area, somewhere between fraud and greed, navigating the mortgage banking system in a way to maximize leverage, reduce interest, and escape responsibility. Today, investing has 1.3 billion views on TikTok, and everywhere you look, there are thousands of young people attempting to get into this profession. Despite all of this, everyone is ignoring the obvious red flags. Researchers have already come up with a name for this bizarre phenomenon. It's called leverage theory, and it's a term to describe the fact that buy and flip investors will want to use as much leverage as lenders will allow. There are many more who are taking advantage of the FHA loan program, or simply lying about loan intentions in order to reduce expenses and increase limits. The same mechanisms that caused the crash in 2008 are now building up in the prime market of 2023, and the system will work as long as prices keep increasing. If this constant upcycle were to suddenly stop, everyone knows the dominoes will topple overnight, the same way it did in the 2008 crash. Thanks for watching this video. Don't forget to like, share, and subscribe to our YouTube channel for more updates. Stay tuned.